CPI inflation came in low this morning. This is not a surprise, mostly because, remember, folks, in order for companies to actually raise inflation for consumers, that is the prices that they charge consumers, we'd actually have to see companies have pricing power, because the worst thing that companies can do is raise prices and then end up seeing their net earnings collapse, because that hurts their stocks, it hurts the executive stock comp, it hurts the shareholders, and it just hurts a lot of people. They'd rather pull a Costco strategy and sell you more goods at lower prices. That is the nature of capitalism. And so when you look at the components, we can see, yeah, there are little tiny components like inner city transportation that are up 2.2% or whatever. But nobody cares, because the big one that a lot of people actually spend money on, like airfares, are down 2.7%. And we've heard of airfares collapsing from the air carriers themselves. Most of the personal services came in relatively low. Overall services coming in at just 0.1% versus the 0.3% expected on a month-over-month basis. And headline CPI coming in at 0.08. That's like the blood alcohol limit versus the 0.2% expected on a month-over-month basis. So when we look at this overall, we can look at some of the components here, but the message is inflation is lower. Look at where inflation is lower as well. Again, rent of shelter, rent of primary residence, lodging away from home, all of them either at expectations or lower than where we would expect them to be at this point. New cars, trucks, and used cars, all in deflation in the last month, negative 0.3, negative 0.5, negative 0.3. This is in spite of the threats that automakers were going to raise prices because of Donald Trump's tariffs, which Donald Trump's tariffs just got an extended reprieve by the appeals court, allowing the Trump tariffs to continue to be enforced at least through July 31st, when the court wants to hear more detailed arguments. And Donald Trump is now bragging about negotiating 55% tariffs on China versus China only tariffing us 10%. Now, of course, can this have longer-term implications in terms of how much broader demand there is in the economy? Of course, but that just reiterates a deflationary cycle. When demand falls, more companies try to reduce prices, they take it in the margin. You generally don't expect in a tariff regime or an economy that contracts to see inflation. You expect deflation to be an early warning of companies starting to lose profit margins. In contrast, though, to airfares, restaurant prices are up. Food away from home category is only up 0.3%, so not even a big deal here. Smartphone prices down 1.6% on the month. This is also despite, Trump's tariffs. It's probably because Apple's iPhone updates kind of suck and they're losing pricing power as well. It's also a lot more competition for phones these days, especially in China. Apparel prices are down 0.4%. Overall, furniture and bedding is down 0.8% on the month. However, some household furnishings are up, like appliances were up 0.8%. So there could be some inflationary impacts that we're seeing at some components here. Appliances, for example, only representing a weight of 0.2% though. So it's just not that big of a deal, mostly because, yes, appliances are a relatively large cost for consumers, but they're not a cost that we recurringly spend over and over and over again. How often are we really buying a new appliance? Once every couple of years. Anyway, that's all factored into the CPI weight. So as a result of this, obviously, markets are very enthusiastic, as they should be. Markets are enthusiastic, or at least were on the reaction. You're already giving some of that back. Markets are enthusiastic because of the potential that we're going to get earlier rate cuts. This is totally reasonable. I still don't think the Federal Reserve is going to do anything until September, but in September we could see rate cuts, absolutely. Oh, by the way, yesterday morning in the Alpha report, we were really bullish on Dave & Buster earnings, up 11% right now in the pre-market. I'll be sending my next Alpha report out within the next 20, 25 minutes here, so if you want to be part of those Alpha reports, make sure you join at mekevin.com. So anyway, regarding the market, obviously, this anticipation that the Federal Reserve is now going to be unlocked to cut rates sooner is going to be an expectation. That's going to be weighed down by this potential that, this China trade deal isn't really that fantastic. in that we still have large tariffs, and those are still going to cause impacts. They'll look good for Trump's POV because it'll be like, look, I got a way bigger number than China. It's fine. But again, the impacts of those will come in Q3. As long as we can get through those impacts, so far, data we're getting on jobs and inflation is very soft landing-esque. And on top of that, the 10-2 spread is sitting at about 0.48, so we're still below shock level right now, which is great, unlike what we saw post-Liberation Day. And we are, of course, seeing the 10-year bond and Treasury bond yields fall, 10-year down about 0.4% at the moment. Although that can fluctuate pretty rapidly throughout the day, so we'll see what happens there. And of course, indices across the board pre-market, nice and green on the CPI report. So anyway, good luck today. I think that broadly, this is very bullish. This takes a negative catalyst away from markets because there were people thinking that we'd have a miss. I don't personally really think that. We're in an environment where we're going to see a lot of heavy inflation. And if inflation is your bear case, then that makes me very bullish. Of course, do I think that our jobs market is still quite likely to weaken later this year? Yes. In fact, that is what makes me the most nervous. In fact, yesterday I made a great video. I encourage you to watch it. It was the only bear case remaining. And we went through a couple institutional pieces on the impact of tariffs eventually on the labor market. Because of like what I mentioned earlier in this video, we don't expect to see tariffs impact headline prices, which is the normal consensus. We expect them to impact bottom line prices for corporations, which show up in layoffs. In other words, layoffs are the way you resolve this. Now, TBD, if we just get these sort of voluntary buyouts and transitions at corporations like Google, as somebody astutely left a comment and said, Kevin, you're talking about how AI is taking jobs away from Googlers. Doesn't innovation usually breed new jobs? Yes. But the problem is those new jobs can sometimes come with a lag. That's the window that we're in. Yes, artificial intelligence will breed new jobs we can't even imagine right now. Innovation always does. And it usually leads to economic growth. The problem is you tend to go through this V recovery where you have to basically reskill humans, and you could go through a, 5, 10, 15-year period of time where the unemployment rate is quite high in response to a new innovation. In the longer term, of course, when people zoom out and study history in hundreds of years, they'll be like, wow, AI created so many jobs. But that will take potentially decades. And in the zoomed in moment of life where we are now, we potentially have more downside ahead of us rather than we have upside on the jobs reports. And so that's really the big catalyst here. And it's one of the reasons why I think, some of the precious metals are likely in a topping environment. Anyway, that's my take. Thanks so much for watching. See you in the next one. Goodbye. Good luck. And I'll be live